Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for May 24th of 2021. Please see our disclaimer for important information. Well, as we begin our chart pack for the week, we revisit our COVID tracker. So the trends that we've been observing over the last several months really are still very much well entrenched. A 7-day moving average of positive cases as well as 7-day moving average of daily deaths continue to trend down with the vaccination program that's currently in place here in the U.S. You can see on the right-hand side, though, that interestingly enough, after we hit April, we kind of hit a peak of about 3.25 million doses administered on a weekly basis, and that number is trending down below 2. So as we now have vaccinated, or we've administered, I should say, about 275 million shots. That includes both the 2-dose variety as well as the one-shot Johnson & Johnson vaccine. That we're reaching a bit of a saturation point, so you can see a lot of the mass vaccination sites are closing down, and they're moving that vaccination program more to kind of a regional level, to drugstores and individual doctors' offices and things like that. Obviously, having a pace of basically 1.75 million shots per week is still good, but we're beginning to bump up now that we've achieved about 47%. We've got a chart on that in a second. Vaccination rates across the country, we're going to continue to see probably a subtle deceleration in new vaccinations on a weekly basis. Here's our high frequency data from First Trust. You can see continuing, I think, overall positive trends, even though commercial flights over the last month have kind of tailed off a little bit. Supply of motor gasoline, don't worry about either of those two. The motor gasoline prices were a little bit low, but we'll have more travel in the summer. People are going to clearly interested in being more mobile, so I don't worry about that. TSA checkpoint data was positive. Hotel occupancy down slightly, but again, I don't worry about those types of things. In fact, as we talk about the inflation data later, it's clear that a lot of the inflation impetus in the last reading, which was well above expectations, came from these sectors that are kind of what I'll call in jailbreak mode, which means folks have been stuck in their houses. They've been immobile for essentially the last 15 months, and now they're getting out, moving around, and you see a lot more of the inflation impetus in these areas that have been locked down, basically. We'll talk a little bit about steel production. That was up. Rail car traffic is up for the month, off slightly for the week. And basically the labor market continues to move in a generally positive trend. The latest data point, jobs number, wasn't nearly as robust as people had looked for. Don't worry about that necessarily. I mean, jobs are hard to fill right now, frankly, and I've actually witnessed this last night at a restaurant that I went to that had an hour-and-a-half wait, and I said, well, I'm staring at open tables in your dining room, and they said, that's fine, yeah, we're open at 100%, but we don't have enough staff to man all of the tables, bus people and waitresses and waiters. So really kind of case in point here that there are plenty of jobs that are hard to fill, but a lot of people that are looking to hire. Here's some data that kind of goes back to that high frequency chart that we saw before. Open table, restaurant industry reservations continuing to move higher, very healthy, not quite where we were in 2019, but getting close. TSA checkpoint, again, moving higher, that's positive, even though commercial flights on the lower right, maybe we've seen a little bit of a tapering off and new inventory being added into the commercial airline market, but not too worried at this point. We saw after the 9/11 issue and certainly after the great financial crisis that air travel took a little while to recover, but the trends are well in place. So supply of motor gasoline, we've already talked about that. slightly off. Don't worry about that. We're getting ready to hit the peak driving season, so feel really good about this data right here. Rail car traffic, you can see that these numbers are really on top of the 2019 data. Very positive. Obviously, we've had a strong rebound in durable goods demand and shipments. So we do have supply bottlenecks that we have talked about quite a bit here on these charts of the weekend, as well as market minutes. Steel production, again, going into automotive builds and durable goods, washing machines, you name it. Steel production on a net tonnage basis continues to trend higher. These are weekly retail sales. So we saw a really good couple of months. I mean, we saw a fantastic read in retail sales last month. And I think that data is continuing. Now, again, this doesn't bifurcate, in-store sales versus internet sales. And there's a chart that I didn't include this week, which shows a really profound, like 20 to 25% year over year decrease, or I should say really a decrease from 2019 for all of the major department stores like Macy's and Bloomingdale's, et cetera. So foot traffic in the malls, foot traffic in the large box retailers is not nearly what it was, but internet sales are through the roof, and you can see that kind of manifested here, that this data relative to even 2019 is actually pretty phenomenal. So consumers have been putting their money where their mouth is. They've been talking up a big game about wanting, about putting money to work, and you can clearly see that here in this retail sales data. We've got some charts from the Philly Fed indices. Now, granted, this is information that's kind of within the Philadelphia Federal Reserve's district, which includes New Jersey and obviously Pennsylvania and that region. So there's a lot of manufacturers there. But I think it's relevant because it does give you some insight on insight to what's going on nationally, because I think these numbers are very representative, and it's not telling us anything that we didn't already know. Frankly, we know that new orders, even though they were slightly off, remain elevated relative to history. You can see that in the trend line here. That's on the left-hand side. Delivery times. Now, this is something that we are actively monitoring. This is something that's going to play out over the next probably the next 9 to 12 months here. And you can see delivery times, lead times are really extending out on a lot of manufactured goods. And here's more Philly Fed data, manufacturing on unfilled orders. Again, lead times are extending. Orders are coming in faster than they can be processed, and that's why we've got unfilled orders here that are really rising. So we've got some supply constraints here, and that's leading to price inflation, kind of more of a supply side, if you will, inflationary pressure, and those are building. Now, some of the component pricing, the input prices for manufacturers, I do believe are going to temper. Those cost inputs are going to go down. But as long as you have unfilled orders like this, you're going to continue to see some pricing power on the part of the manufacturers. Now, on the right-hand side, you've got capital expenditure expectations. This is capital spending on the part of manufacturers to increase plants, to add new equipment, to add perhaps a new production line, et cetera. And so the intentions here continue to be higher in the face of this improved demand. So if you look at it from a manufacturing standpoint, which again represents a minority component of our overall economy, it's very healthy, if not for the price input inflation that we've seen here as of late. Now here's inventory. So manufacturers are increasing their inventories. This is on the left-hand side. And obviously they want to fill orders. There's supply chain and delivery choke points. We've seen that well entrenched in that last slide. But they're increasing inventories at a time where there is a lot of demand. And this is a good sign because inventory build can be a significant contributor to overall economic growth. So we do like to see this. Now on the right-hand side is what I just mentioned a couple minutes ago, and it's the input price and also the delivered price, and both of those are moving higher, as you would hope in a normalizing economy, in a growing economy, a economy that's entering a new phase or a new economic cycle, that the manufacturers and producers of goods that are facing cost headwinds, that are accepting higher costs for inputs into their manufactured goods, are able to actually get that back in terms of prices received when they sell those goods. So I think this is healthy. It gets us back a little bit more normalized. We've been manufacturers have been very challenged on the price power side for quite some time. So something that I wanted to touch on real quickly, and it's been well advertised that the semiconductor industry has faced a lot of supply choke points, and we've got a chart at the very end of this slide which kind of talks about the electronic component of automotive vehicles, and clearly the semiconductor content in everything that enters our daily life has gone up, and so more chips need to be produced. But the lead times on chip production have really extended out. Now we know that we've had a lot of supply chain issues. We know that COVID, I think demand picked up a lot faster than the supply chain could absorb and could react to after all the shutdowns last year. And then obviously we've had some weather-related issues here in Texas for Samsung, which is a major chip producer here in the States. And so all of this has kind of come together in confluence to create these really, really long lead times. And again, there's something else that we're going to have to fight. This headwind that we're going to have to fight is basically going to be a bit of an anchor to economic growth, frankly, over the next year because of this issue. Economic Surprise Index from Citigroup. Now, we've seen a lot coming off the trough, and last year in the pandemic, saw a lot of positive surprises, a lot of data that we frankly were not expecting to see, especially that soon after the crux of the pandemic. But we're getting back to a little bit more of a normalized area right now. So we're kind of anniversarying some of these wild data points and getting back to a little bit more of a kind of a benign scenario, which the read through for me is that when you get a surprise index on economic data releases that's pretty benign, meaning that there really aren't any terrific surprises, and forecasters are able to do a pretty decent job of kind of giving us their view of what the data is going to look like, and we don't get surprised by what we see. That tends to have a muting effect of some degree into like stock price volatility, and wild swings in the bond market. Contributions to the leading economic index here I thought was interesting because we've seen an LEI that's been on balance very positive. You can see that building permits, which have been strong in the face of a really tight housing market shortage of inventory, new inventory as well as listings for a lot of the major markets. So that's had a big impact. Biggest impact, of course, has been initial claims. That data has been really positive as of late and trending down a lot faster than expected. And so that's had the most influence. But behind that, you can see building permits, as I just mentioned, and then new orders for the Institute for Supply Management Index. These are manufactured good orders, and that's had a real positive impact, as well as credit. This is a very busy chart, but basically it shows you the inflation expectations across a lot of different geographies. And I put this in here to say that inflation is not just a U.S. phenomenon. As we have this kind of synchronized global recovery, if you will, it's clear that inflation is playing a part in a lot of other economies, as well as, this doesn't have the UK in it, but it has Germany, Spain, Canada, Japan. Trend lines are all the same. Especially for places like Japan, this is important for their economy that they've seen a decline, a systematic and systemic decline in inflation expectations for multiple years, and then coming out of this pandemic, that those inflation expectations are beginning to rise, as they are really in every country in this chart. So again, the U.S. is not on an island here. I think this is very symptomatic of a successful synchronized global recovery. I think these are positive developments when obviously inflation to the end consumer is rising because producers feel that they can gain, that they have the pricing power to raise prices, and that this is very symptomatic of an improving overall economic backdrop. A quick check-in here on freight. So this is the Baltic Freight Index. This is one component of these freight indices. A Baltic Dry Index is another one, but this is a freight container index. I think this has as much to do with a shortage of containers. Again, coming out of the pandemic, there was a shutdown on a mass scale across the globe. Demand picked up a lot faster than the supply chain could tackle it. And so I think we saw this even before the Suez Canal blockage, where rates were moving higher, and that had a lot to do with the shortage in containers themselves. But after that lull, they're picking back up again. Again, this is just symptomatic of an improving economy where the supply chain is struggling to kind of keep pace, and as a result, we're seeing cost increases across the spectrum. Then we'll get into a little bit of different economic data. So this is a plot of yields and consumer price index. And so, what it has on the y-axis is a 10-year bond yields, and on the x-axis down below, you can see the consumer price index. And this is a core index, so it excludes food and energy. And we're in really rarefied air in the sense that we're trending now, as of the last data point, closer to a 3% year over year consumer price index change. But generally, we would be expecting a lot higher bond yield at this point in time. When inflation manifests itself, usually 10-year treasury yields move in tandem with that. 10-year treasuries are a lot more influenced by inflation expectations. And when you have observed inflation that leads to increased future expectations for inflation, you generally almost always see a response in the 10-year bond yields. And we haven't really seen that yet. And so, that arrow that points to the current mark right there is just symptomatic of kind of this weird dislocation that we have in the market right now, that where we are now, we should be at probably about a 5% yield, all things being equal with the level of inflation that we're seeing right now. All right, so this is again another busy chart, data from Bloomberg but reported by Arbor Research, and it shows you the different levels of 5-year expected inflation and the probability rates, and they've all gone up basically from really about call it 9 months ago, and some of these have leveled off. So, but what's really important down here below in that red line, the lowest line you see there, that is inflation expectations over 5 years, where the inflation rate will be at least 3%. Now, all those other lines represent lower expected inflation levels, but the red line represents a 5-year inflation rate of 3%, and that expectation has moved all the way up to 40%. That's pretty profound. Obviously, lower rates have higher probabilities, but to have a 3-year inflation expectations over 5 years, not 1 quarter, not 1 month, but 5 years, 40% is really telling here. And it suggests that there's increasing confidence of that longer inflation regime. You know, a lot of talk lately has been, okay, well, the numbers were influenced by a lot of these, what we call these, you know, I'll call them the jailbreak sectors, hospitality rates, and you know, these mobility indicators. So you know, we had a lot of influence on the inflation number by these areas in the last reading. But we still have a lot of commodity price inflation, lumber, steel prices, et cetera. Even though iron ore has come off its peak, it's still pretty high. But you know, but a lot of people in the intelligentsia at the Fed level have said, oh, well, we believe that these inputs are going to be transitory, and so inflation is going to spike and then move lower again. I do think inflation is going to level off, but I just kind of look at this 40% probability number, and what it tells me is that we're going to be living with a higher level of overall inflation in the future than what we've had, experienced over the last 5 and even the last 10 years, frankly. So continuing the inflation theme here, I have the chart on the left-hand side, which reflect the influence of those mobility-related sectors on the CPI reading last month. Again, the hospitality prices, food prices, restaurant prices, used car prices, you know, all of these things related to increased mobility coming out of a pandemic that have been really subdued over the last several months, and you know, ever since the advent of the pandemic. Yeah, it really had a breakout. And I call this the kind of the jailbreak effect. Is, you know, more people are being vaccinated and they're getting out, and it's driving cost inflation higher in those particular sectors. And you can see this chart. You know, it's enough to talk about it, but it's another thing to actually see it in motion. You can see the profound increase that we saw in this last data point here related to those mobility sectors. Now, on the right-hand side, it's interesting that you know, we've been talking about inflation here in Charts of the Week for months now. We've been monitoring these price increases. We've been talking about it. It's manifesting in the data. And what's interesting here on the right-hand side is now it's being discussed in earnings calls. So we just really completed the first quarter earnings season for companies reporting data from, you know, January through the end of March, and they had earnings conference calls after that. And we can basically concluded all of that activity. You can see that there's been a huge spike in the number of mentions about inflationary pressures that companies are seeing in their own business. So it's not just in the data, it's actually in the rhetoric now too. All right, and so another point that I want to bring up here as it relates to the consumer price index is rents. And you know, we definitely saw a drop in rental prices last year. Evercore ISI data, you know, clearly shows us what happened there, and things kind of leveled off. But a funny thing happened as we started to kind of reopen the economy. We've seen that rent inflation, or the rent levels going back up, and that's a really interesting development. I thought it would probably take a little bit longer for this to kind of manifest, but it shows you the degree to which I think the things are kind of returning to a more normalized level. So why is that important? Well, if you look on the right-hand side, you can see that the housing component and owner's equivalent rent, which is really a function of overall rents, is over 42% of the consumer price index. So this is just more anecdotal evidence of inflation within the pipeline. This doesn't have anything to do with manufacturer prices or producer prices. This is at the consumer level where rents have an outsized influence. And so this is just one more data point that kind of seems to confirm in our eyes that we're going to have that entrenched inflation and probably entrenched inflation for a little while, even though it'll crest, roll over, and kind of probably settle in at a higher level than what we've been used to. All right, well, now we've got an overlay of disposable personal income in the red. and we overlay that with the consumer price index. And so, what this tells you is you got the CPI in the green, and you've got the red dotted line representing disposable personal income. There's a lot of noise in that number, obviously, because there were stimulus payments that went out to people, which caused those spikes. But you can see that there's a pretty decent relationship. It's not super strong, but it's not. It is definitely positive where you see higher inflation, or excuse me, higher personal income levels. You tend to see the inflation numbers follow as well, and this chart kind of highlights that. So a quick comment here on the commodity basket, and in particular the oil market. So this is the July contract for Brent crude, and Brent generally runs a few dollars above a West Texas Intermediate. And what we see here is kind of the rolling over in the contract. Now this is a pretty short data series. It just goes back to essentially 30 days ago. But with the increased, I guess, conversation over the last week out of Iran in these negotiations, which have resumed under the Biden administration, there seems to be, at least from the Iranians' perspective, kind of a quote-unquote construct of a deal, even though we don't really have any of those details yet. But what it's doing is the market is presupposing that there's going to be more Iranian crude being put onto the market, and that's driving short-term energy prices down. Well, I'm going to talk about Bitcoin. I've got two slides on cryptocurrencies here, and let me present Exhibit A on why cryptocurrencies are not going to be a reserve currency anytime soon. Here you can see the immense volatility of Bitcoin, particularly over the last several weeks. Some people call this the Tesla effect, where Tesla sold its holdings, which, by the way, created a nice windfall of non-operating profits for Tesla in their last quarter. But nevertheless, the news of that got out, and it really began to put some pressure on Bitcoin. You can see here it's broken through most of the major resistance levels, which is kind of interesting because it just plowed right through it. And so, again, the cryptocurrency market is a speculator's paradise, and it is feast or famine. And, you've got to know, let me rephrase that. You have to have the stomach for it based on this volatility. And so here's a chart from the Visual Capitalist, which kind of shows you some of these major moves in Bitcoin. And so you don't rely just on the chart that I just showed you, because that's very recent activity. But if you go back in time, you can see that there's been some really dramatic swings. And so I'm not trying to scare people out of investing in Bitcoin, but you got to know what you're getting into. And I think the last two charts, if nothing else, will highlight the fact that it is literally feast or famine in cryptocurrencies. And caveat emptor, I should say, buyer beware of what you're getting into. There's some great short-term rewards, but it's hard to know when to get out. We don't do trafficking in Bitcoin right now. In fact, our custodian, Charles Schwab, really hasn't established a framework for us to custody Bitcoin. So, we're just recommending folks go to Coinbase if they want to play it. But, for those of you along the line who have messaged us or asked us these questions about cryptocurrencies, I offer you these two slides to show you basically the increased volatility levels that you are apt to experience in this market. All right, well, we're going to talk about some stock and investment market related information here for the next few slides. You can see here, this is an overlay. The black line represents the S&P 500. And again, not a long data series, but it just shows you the activity over the last several days that we've seen. huge outperformance by that pink line, which is a non-profitable technology basket. And this has been a theme that has really played out over the last year. It's very ironic, over the long haul, over a long period of time, fundamentals really do win the day. But in the short term, in these little microcosmic windows like we have here, we're very much apt to see these non-profitable companies really take the lead in market performance. And it's a very unusual circumstance that we see here. We've got the NASDAQ, which is highly embedded with essentially technology companies, so that's outperforming the S&P 500 right now. But the fact that we have such huge outperformance by these non-profitable companies in the technology world is really quite surprising. And this is a quick chart here on the correlation levels between the SPY and the IEF. And what are those? So the SPY is essentially the ETF for the S&P 500, and the IEF is the ETF for the 7 to 10 year Treasury. So this call it a proxy of the stock market and the bond market. And what we're seeing in these correlations is that they're rising, right? And typically, you have an environment, and it's very well evidenced here because this time series goes back to essentially 2007, where usually when the equity market goes up, bonds go down, and there have been points in time where when the equity market goes up, bonds go up, and vice versa, but they usually do not move in tandem. They usually move opposite to each other because the stock market prices, go up, and then you see essentially bond prices go down because yields move higher. But what we've seen here lately is that we've seen this increased correlation. Now, on this chart, it shows that the correlation is about 0.25, which is actually very low, but it is positive. And so the interesting thing here is that we're seeing a bit of a positive correlation in the movement of stocks and bonds, which, again, if you're a financial planner and you're looking at this on an interim basis, you would definitely want to see the negative correlation because it reduces your risk, and you're investing in fixed income to diversify away the risk of the equity markets. And you certainly don't want to see positive correlation. But again, it's something that we're monitoring. I don't signal the alarm bells just yet, but just interesting in this recovery environment and this kind of entering this post-pandemic phase of the economy that we see these two things exhibiting positive correlation. This is a chart that plots the S&P 500 price index versus the commodity index. And what this tells you right here is that the commodity basket is hugely undervalued relative to stocks, or conversely, that stocks are very much overvalued relative to the commodities. And so I think this is a part and parcel to our theory of having a reasonable exposure to the commodity basket for valuation purposes. A quick chart on dividends, and I've talked about the relationship between the yield on fixed income versus the yield on equities. And even with this price run up, what we've seen here is that dividend rates and income differentials between equities and fixed income still remain heavily favored towards equities, despite the fact that we've seen such a strong price movement. And the slide that will come after this will show you what is providing this mother's milk for this yield. And you can see the third from the left, actually the first three, you can see the S&P 500. Overall yield is 1.4, the 10-year Treasury yield's about 1.7. So the index itself is yielding less than Treasuries. And that basically just kind of that inflection point where fixed income rates went higher than the equity dividend yield just happened here a matter of months ago. S&P 400, which is mid caps, even lower, and then even lower for the S&P 600, which are small caps. But if you break down the components and you say, what are those companies that are the leaders in dividend payers, or the ones that have the highest dividend growth rates, and all of those are represented on the right hand of this chart, you find a very dramatic differential, over the 10-year Treasury yield now of around 1.7. So stocks, especially the high quality stocks, the ones that are leaders in their industries, generating profits, free cash flow, that are now plowing that back into not only share repurchase, but also dividend increases. You can see here that there's a huge income differential amongst that higher quality component. And here's the chart that really drives this. Again, sales are the mother's milk of profits, and here are the profits that are generated from the sales that have trended a little bit better than expectations. Profitability, profit margins on the part of S&P 500, if you back out the financial sector, have been really, really strong, and this is providing this feedstock into these dividend increases. And I'm going to end on this slide. I kind of referenced this earlier, but I thought this was really interesting. Comes to us from IHS and Deloitte. But if you go back to 2000, again, the beginning of the decade, 18% of your total vehicle cost was related to automotive electronics or electronic components, which could be semiconductors, it could be capacitors, it could be a lot of different things, but just the electronic component of the vehicle was only 18%. And you can see here, if you go to 2010, that moved up to 27%, and now 40% of a vehicle's cost, and this is an average, is related to electronics. And these are sensors, these are things that need semiconductors to operate. And this is really a big reason why we've had such a choke point in the automotive production sector, and why used car prices are through the roof, is because essentially 40% of a car depends on the things that are in very, very short supply with long lead times right now. And that's only going to become more acute as we get to 2030. You can see here that just shy of a half of a total vehicle's cost is going to be related to electronics. So I had been actually looking for this type of data for quite some time, and just found it in the research this week. Thought it was interesting to pass along to you, so I hope you enjoy that. Well, that will do it for this week. Appreciate you spending the time to listen to Charts of the Week. On behalf of the entire team at BKA Wealth, we hope you have a safe week, productive week, and we look forward to seeing you again soon.